Hi. Good morning again. So today's the meeting is called to order. Hearing Capital Markets Subcommittee. Appreciate everyone's indulgence for votes for those important pieces of legislation. Today's hearing is entitled Oversight of Financial Industry Regulatory Authority. We will begin with opening statements and then turn to our panel. And I'll begin by yielding myself 3 minutes. So, today we will hold, as I say, an important hearing to provide for much-needed oversight of the Financial Industry Regulatory Authority, or Finra. But despite its status as a self-regulatory organization, some would argue that it hardly resembles what would many call an SRO, and what now appears to be more of a quasi-government regulator. Some even call a deputy SEC. Indeed, in recent actions are closer to that of a ever-expanding federal bureaucracy that we've become accustomed to now in Washington that seeks to go further into people's lives and businesses and every citizen. And so, despite FINRA's enforcement of rules for the broker-dealer community that it regulates, it now recently has come out in favor of the SEC moving forward with a uniform fiduciary standard, a sentiment shared by SEC Chair Mary Jo White. I should point out that when Chair White was before this full committee some time ago, just last month in March, she was unable to provide this committee with any studies or any other data, especially as it relates to the proposal's impact on low and middle income investors, which convinced her that the need for the new proposal in the first place. So I hope that Mr. Kitchum can elaborate today on those studies and any empirical data that he may have reviewed which has persuaded him and FINRA that the SEC should move forward on sweeping regulations and reconstruction of our security laws. As I previously noted elsewhere, in our private conversations, other conversations, FINRA's comprehensive automated risk data systems, also called CARDS, is a solution in search of a problem. Even after changes to the original proposal, I remain far convinced that this costly and intrusive and also burdensome proposal is actually needed. Its costs will far outweigh any potential benefits and will further squeeze out smaller broker-dealers who are already facing increased regulatory compliance costs. Additionally, CARDS would establish a new government database that would retain sensitive information about millions of Americans that can be, as we've been told, re-engineered to determine their personal identities. This, as some have said, amounts to the CARDS proposal being short of a full deck. As FINRA is attempting to stand up CARDS, it is also bidding to become the operator of something called CATS, the Consolidated Audit Trail. In bidding for CAT, FINRA is in a unique position to the other bidders on this proposal. Why is that? Because it sits on the SRO committee that will recommend a winner to the SEC. This would appear to be a blatant conflict of interest, but notwithstanding, having a single financial regulator with the data held by CAT and CARDS, I think should give every American some pause. In all, FINRA continues to step far beyond, I believe, the bounds of its originally intended jurisdiction and into personal investing decision-making of everyday Americans. It is this committee's duty to ensure that FINRA supplements but does not supplant the SEC. So with that said, I want to thank the panel, which consists of one, Mr. Kitchum, for your appearance today at the hearing. And I look forward to not Mr. Sherman, gentleman from Massachusetts, for 2 minutes.
Thank you, Mr. Chairman. I appreciate your indulgence. I think there has been some recent activity that indeed does call into question FINRA's conduct. While some may suggest it's hyperactivity, I think that the events going back to May 6, 2010 flash crash, when the Dow Jones Industrial Average rapidly dropped about 600 points in 5 minutes before quickly rebounding, that event has brought further evidence to light. Recently, on April 21, 2015, the CFTC and the Department of Justice announced that the agencies were bringing civil and criminal charges, respectively, against Davinder Singh Sarao, a UK trader who had been manipulating the global financial markets from his home for years for allegedly helping to cause the May 6, 2010 flash crash. As reported in the New York Times, Mr. Sarao is accused of entering and withdrawing thousands of orders worth tens of millions of dollars, each on hundreds of trading days, in an attempt to push down the price of futures contracts tied to the value of the Standard & Poor's 500, a practice known as spoofing. Once the price fell, Mr. Sarao would buy the contracts and reap the profits. However, on the day that the flash crash on May 6, 2010, prosecutors contend that Mr. Sarao placed large orders repeatedly over several hours, leaving the market vulnerable to big moves when another big trade came in from an investor in the United States. Reports indicate that the regulators completely missed Mr. Sarao's activity because they weren't looking at complete data. As a result, it took regulators 5 years to actually track down the actual culprit of the flash crash. The equity markets have rapidly evolved. Now there are thousands of stocks and over 1,000 ETFs trading on 11 stock exchanges. There's been the introduction of over 40 dark pools. And I think what we would like to hear from the witness is whether the fragmentation of liquidity has hurt your cross-market surveillance methods, and do you think there are too many venues to trade securities on? If Finra is responsible for regulation in the securities industry and can reach across securities markets centers to look for manipulative behavior, and I'm just wondering, with the evolution of the markets, does Finra still have the ability to do that, to reach across asset classes like futures and currencies? Since many strategies today employed by proprietary traders reach across various asset classes, do you think it would make sense for the CFTC and the SEC to work more closely together and share that information? Those are some of the questions that I think the flash crash investigation has raised, and be interesting to hear the answers from our witness, and I yield back the balance of my time.
The gentleman's time has expired. Mr. Hurt, for 2 minutes. Thanks.
Thank you, Mr. Chairman. Mr. Chairman, I want to thank you for holding today's hearing. I'm pleased that the subcommittee has taken the time to conduct oversight of the Financial Industry Regulatory Authority and its activities. Making sure that we have fair and effective regulation is vital to maintaining efficient capital markets, especially for smaller firms that are subject to Finra's supervision. While a larger firm may be able to absorb Finra's compliance costs, smaller broker-dealers are often hampered by them. Finra's proposed cards initiative is one example of an idea that I believe is too costly and burdensome, particularly for smaller firms. Investors in Virginia's 5th District, my district, and across the country rely on Finra to regulate broker-dealers in a responsible way. Finra also has a responsibility to operate in a fair, consistent, and transparent manner given the authority that it exercises. Finra must be mindful of the potential economic impacts its rules may have, particularly at a time when economic growth remains vitally important. I believe Finra should focus on streamlining its duplicative systems and improving its operations so as to better serve the broker-dealer community and their customers. I hope that today's hearing gives us an opportunity to examine the work that Finra is doing and the ways in which we can ensure that broker-dealers remain efficiently regulated and vibrant for years to come. I look forward to the testimony of Mr. Ketchum, and I thank him for his appearance before the subcommittee today. And, Mr. Chairman, I yield back the balance of my time.
Great. The gentleman yields back to the gentlelady from New York for 3 minutes.
Thank you, Mr. Chairman, for holding this important hearing. And we talk a lot about investor protection on this committee. Excuse me, and Finra plays a central role in protecting investors in our securities markets. Investor protection takes many forms, but in general, we focus on two main areas. Number one, ensuring that investors have enough information to make fully informed investment decisions. And secondly, making sure that investors are treated fairly by the securities professionals with whom they deal. These categories do overlap. Sometimes investors get their information about a security from their broker. In that case, ensuring fair treatment means making sure that the broker discloses all the pertinent information to the investor. And it is in this second category of investor protection, ensuring fair treatment, that Finra plays an enormously important role. Every broker and brokerage firm that sells securities to the investing public must be licensed and registered with Finra. The regulation of broker conduct is extremely important because of the inherent informational advantage that brokers have over ordinary investors. Brokers, by their very nature, have access to a great deal of information that investors do not have. Most importantly, since brokers take orders from both buyers and sellers all day, they know which products are in demand. As a result, it's important that appropriate standards are in place to ensure that brokers don't use that informational advantage to the detriment of investors. That's where Finra comes in. Finra ensures that brokers don't mislead investors and that they don't sell investor products that are inappropriate for them or are deliberately designed to be too complex for them to understand. And while this is a critically important role, it's not the only role that Finra plays in our markets. It also plays a key role in market surveillance by identifying red flags and trading patterns that suggest possible insider trading or fraud. For instance, if there is an unusual amount of buying in a particular stock right before a company announces it's being acquired, it's FINRA that usually detects that activity and refers it to the SEC's Enforcement Division. In 2014 alone, FINRA referred over 700 matters to the SEC for possible enforcement. So without these kinds of red flags and referrals from FINRA, the SEC would be significantly less effective. Also, it is an independent relationship and one that we should periodically examine to ensure that everything is working properly. That's why we're here today, to conduct this necessary oversight of FINRA. So I look forward from hearing from our witness, and I yield back the balance of my time. Thank you for calling this hearing.
Thanks, Gentlelady. Now we turn to our panel, or Mr. Kitchum. Chairman of FINRA, thank you very much for your indulgence and your patience, and you are now recognized for 5 minutes. You've been here before, so you know that your complete testimony in writing has already been submitted to the record, and you're recognized for 5 minutes. And the one thing is, we have new technology here in this room. I'm not sure how to tell you to turn it on.
Green light, but
There you
now
go.
it's working. Great. Chairman Garrett.
Oh, the green light, I think, down there, I
got
haven't
you.
seen, is your time, and then it goes to yellow for 1 minute and red for the...
Thanks.
Right, yeah.
Chairman Garrett, Ranking Member Maloney, and members of the subcommittee. I am Richard Ketchum, Chairman and CEO of the Financial Industry Regulatory Authority, or FINRA. On behalf of FINRA, I would like to thank you for the opportunity to testify today. FINRA oversees approximately 4,000 brokerage firms and over 600,000 registered brokers. FINRA's programs range from registering individuals to examining securities firms, writing rules, enforcing those rules in the Federal securities laws, and educating the investing public. FINRA carries out this work under authority from Federal law and oversight by the SEC. Our work is informed by a board and advisory committee structure that incorporates both public and industry representation. In addition to regulating brokers and brokerage firms, FINRA monitors approximately 99% of all trading in U.S. listed equities markets, or nearly 6 billion shares traded each day. In fact, FINRA's market surveillance systems process approximately 30 billion market events each day to closely monitor trading activity in equity, options, and fixed income markets in the United States. And I would note to the question raised earlier in the statements that FINRA has, for decades, looked at order information with respect to its surveillances, and for a period of 5 years has had surveillances with respect to spoofing and layering that has resulted in multiple disciplinary actions. The programs we operate are continually evolving to improve and reflect relevant changes in industry, operations, and technology. In my written statement, I describe our rulemaking process as well as the economic analysis we build through our Office of the Chief Economist, as well as our retrospective rule review process, which has just resulted in the first set of rule changes approved by our board in April. Our examination program has shifted over the past few years to a far more risk-based system, one that is built on gathering information prior to examinations, evaluating the risk areas posed by an individual firm, and focusing resources on the areas where the most risk to investors lies. Alongside these efforts, however, we have maintained our commitment to regular on-site examinations, and we conduct these exams on cycles that range from annual to every 4 years, depending on the firm. We have also enhanced programs such as our Office of Fraud Detection and Market Intelligence, and added new ones such as our High-Risk Broker Program, in an effort to develop new ways to quickly identify and address potentially harmful conduct. When we find misconduct and bring disciplinary actions, we focus not just on fines, but importantly on restitution to harmed investors. Last year, we ordered over $32 million in restitution to customers, and cases brought by other authorities based on referrals from Finra resulted in even more money returned to investors. In the market regulation area, the primary challenge is to ensure that regulation is effective in today's increasingly fragmented marketplace. Through our work for exchange clients, Finra has been able to aggregate trading data across the markets to conduct comprehensive cross-market surveillance. This cross-market surveillance enables Finra, in partnership with exchanges and the SEC, to better protect investors and promote market integrity. Finra also is working to design surveillance programs that will span equities and options markets together to identify potentially manipulative conduct across products. And of course, when the SEC's Consolidated Audit Trail is functional, that will be the most complete picture of market activity and a vital tool for effective regulation. Complementing these regulatory and examination programs are efforts to enhance the information available to investors. Finra created important transparency for the corporate bond market with the launch of our TRACE system over a decade ago, significantly reducing spreads in that market. We have now expanded TRACE to include agency debentures and many asset-backed securities, with more to come over the next 12 to 18 months. We also recently began collecting and making public reported volume and trade count information for all dark pools. Market participants, investors, regulators, and academics are now able to see with unprecedented granularity volume information and trends regarding dark pool trading on a security-by-security basis. Finally, I would note that 10 years ago, Finra established the Finra Investor Education Foundation to provide investors with useful information and tools. Since its inception, the Finra Foundation has approved nearly $100 million in grants and targeted projects, and these efforts have led to tangible benefits for investors in all parts of the country. In all of these areas and others, Finra remains committed to working closely with investor and industry representatives, fellow regulators, and our oversight committees as we continue to carry out our mission of protecting investors and safeguarding market integrity. I appreciate the opportunity to testify today and would be happy to answer any questions you may have.
Great. Thanks. Appreciate your testimony. So I'll recognize myself for 5 minutes for some questions. So the predecessor of Finra was a couple things, but NASD. And I would argue, many would argue, that that was a true self-regulatory agency. And I would argue that Finra today is neither a true self-regulator nor is it a government regulator, but it acts more like a deputy of the SEC than it does as a self-regulator. It was beginning of this year, a guy from the Mercatus Center, Hester Peirce, suggested several ways to look at this issue that I just laid out, and suggested several ways to improve and maybe to restore the FINRA's structure, if you will, and to improve its accountability, and as he put it, quote, to reshape FINRA into a true self-regulatory organization or regulator that is actually run by the industry it regulates and allowing the emergence of competing self-regulatory organizations. So I'll give you a minute here to respond. Should the membership, if you will, of FINRA have a greater say in its operations, greater say in its organization, greater say in the policies that it proposes, greater say in the rule proposals, greater say in its agenda than it does now? And I understand, and you laid out in your written testimony, the advisory committees and that sort of thing that exist today. So I'm saying, should there be greater than what already exists as in the current structure?
Well, the short answer would be I think the balance is correct today. I was honored to work and serve at the NASD throughout the 1990s,
right,
and saw the evolution of the NASD into a balance that I think is very similar to FINRA in those 1990s. I think what is left is a board that has a majority of public members, but has industry members that reflect each of the segments of the industry to ensure that there is input with regard to any rules or questions with respect to our program.
So
that's built across committees, both of small member firms, which I recognize the points made earlier that absolutely require our attention, as well as committees on a subject matter basis. So I believe what
with those committees, and there's a whole slew of them, I understand that.
Yeah.
Would you say, honestly, that those committees are the ones that actually shape the policy in the rules that come out, that get proposed?
Yes, I would say they have a great deal of input. The decisions are fundamentally decisions that have to be made by the staff and the board, which is absolutely the way it was at the NASD.
So
but the input of those committees get directly communicated to the board.
Right.
Not something we do, but directly communicated to the board.
So since you were around both times, here and then, where today do the actual ideas or the proposal, where do the actual proposals come from? Do the actual proposals come from the committees, or, as you just said, the staff and the board? So does the staff say, here's the idea, here's the proposal, and then goes to the committee and says, hey, give us your 2 cents on this? Or is it the other way around? Is it is it from the bottom up? Yeah.
Chairman Garrett, I think the answer is both. We get ideas from committees that lead to rulemaking. We get reaction to suggested proposed rules from committees that profoundly change and adjust what the rulemaking is because of the valuable input they provide, as well as input from the standpoint of investors.
And so, to take a particular example, such as the cards idea, where did that come from? Did that come from the bottom up, from the small broker-dealer suggesting that, or did that come from staff and the board?
No, the cards proposal came from staff and its experience in using data analytics with respect to the exam program.
I'm sorry?
The cards proposal came from the staff as a result of our experience in using our data to analyze and try to target our exams and looking to ways to do that more effectively from the standpoint of an early warning system. The proposal has consistently evolved as a result of comments made by folks in the industry.
And does the committees at the end of the day have a, I don't want to use the term veto, which is too strong of a term, but something akin to that when these things come down?
No, and they should not. Fundamentally, Finra should, and what Finra provides, should be an independent organization that is informed by the industry, that provides a level of formal and informal input that is dramatically different than the government, but its decisions should be independent.
So why do you think it is when I meet with a lot of the smaller guys that they say that they feel that Finra is something that they have no communication, no contact, no influence with, that it's just, my word, not there, aloof, separate from them? Why do you think why do I hear that from the folks?
Well, I feel badly that you do get it from the folks. Small business, small broker-dealers have a challenging environment. We try to interact with them regularly. Both I and my staff meet with small firms around the country, and we have a small firm advisory board that regularly changes, that includes both members that are elected by small firms as well as additional members that provide great value. So we try to get and we have 3 representatives of small firms on our board as a matter of requirement at all times. So I do believe small firms provide a lot of input into Finra.
Right. Well, my time has expired, and I also want to recognize Mr. Hill for his expertise and experience on these matters and his advice to me on these issues going forward. Thank you, Mr. Hill. With that, I now recognize the gentlelady from New York, Ms. Maloney.
Thank you, and thank you, Mr. Ketchum, for your testimony. And I'd like you to comment on this article that was in the Financial Times earlier today, and it said that U.S. banks push for a delay in reporting corporate bond trades. Mm-hmm. And apparently they are saying that there's a lack of liquidity in the bond market, and that if you delayed your 15-minute requirement of reporting trades to the TRACE system, that it would help the liquidity problem. So I'd like you to comment on this proposal and on whether or not you believe there's a lack of liquidity in the corporate bond market or municipal bond market, and do you think that a delay in the reporting time for large corporate bond trades would improve liquidity?
Well, we are reaching out to the industry. It's an excellent question, Ranking Member Maloney, and we regularly have conversations over the impact of TRACE reporting. As you know, there have been dramatic changes with respect to the fixed income market in recent years, many of them coming the reaction of the failures and market impact coming out of the credit crisis. That's led to much higher capital requirements, the Volcker Rule that limits the ability for proprietary trading with respect to bank holding companies, range of other issues that have all had significant impact from the standpoint of the liquidity of the fixed income market. So most of the comments we have heard focus on the least actively traded issues. We are going to do, I think this should be analyzed from a matter of data, and we are going to do additional analytical work to look at whether there has been a measurable change in liquidity with respect to those type of issues, and consider very closely several of the suggestions, most of which focus on the timing with regard to the reporting of larger trades. I'll note the other side, though, and I know you are very familiar with this, which is TRACE has resulted in a dramatic reduction in spreads that, for the standpoint of the fundamental retail investor or those of us who invest indirectly through mutual funds, has dramatically reduced the cost of trading the fixed income market. That's not something we should want to lose any more than the transparency TRACE provides to allow you to evaluate the quality of the executions you receive. But we take liquidity concerns seriously, and we will do both statistical analyses and reach out more to the industry.
Thank you. I'd also like to ask about the report that Finra and the SEC recently published on the treatment of investors who are senior citizens. And in that report, you found that some brokers are still making investment recommendations that are totally inappropriate for seniors. And as you know, we've had such a low interest rate return since 2008. And while I believe that this monetary stimulus has been necessary to lift the economy out of our deep recession, low interest rates mean low yields, and that has hurt the savings account and conservative investments of our seniors, and they usually relied on it. So my question is, do you think that this extended low interest rate environment is the main reason why broker-dealers have been recommending riskier and possibly unsuitable securities to our senior centers, in our senior centers and our senior citizens?
It's an excellent question.
The senior investors.
I think it has been a contributing factor for exactly the reasons you so eloquently put out. Senior investors particularly are often dependent on a fixed income and very dependent on their investments, have been dramatically impacted with regard to low yields. And the temptation to reach for higher yields with respect to a range of complex or less liquid investments is very real. And the temptation of the industry to sell them even when they are not suitable is something that we have a great concern of, and we have certainly seen instances. I would emphasize, generally speaking, the industry is very careful from that standpoint and has worked, I think, considerably harder from the standpoint of the quality of controls and disclosure they use. But the concerns are real, the abuses have happened, and our focus is very much on senior investors. And indeed, we just, with Susan Axelrod, who's sitting right behind me, her leadership opened up a senior helpline to try to give seniors the opportunity to have a place to go to ask questions, whether about their accounts or otherwise. So the concerns you raise are very real.
Thank you.
Thank you. The Vice Chairman is now recognized for 5 minutes.
Thank you, Mr. Chairman. Thank you, Mr. Ketchum, again for appearing before our committee and for your the contact that you've been in with us as we try to work through some of these issues. Obviously, from the big picture, when we look at the at proposals such as the CARDS proposal, the Uniform Fiduciary Standard proposal, what we're trying to balance, and I know you're sensitive to this, but what you're trying to balance, it seems to me, is a regulatory scheme that is efficient and is necessary on the one hand, and that on the other hand does not limit consumer choice and jack up consumer cost, because that's ultimately what happens, it seems to me, when you have overregulation. Following up along Ms. Maloney's questions, one thing I would point out about the Uniform Fiduciary Standard, and ask you to comment on this, is that if there are abuses already under the suitability standard, it seems to me that you all already have the power to be able to to go after folks who violate those standards. And if that's the case, then why would and we all know that the broker dealers have all kinds of requirements they have to live up to. Why would we risk the possibility of higher costs, lower choice, fewer choices by imposing a higher standard that's not necessary?
Well, Congressman, first I want to say I think you set out the balance absolutely correctly, and I completely agree with the way you phrased it. I think that has to always be the way we look at each initiative, certainly from a rulemaking standpoint. On the fiduciary standard, I think some of the references here refer to my statements at a variety of conferences saying that I believe that the right way to move forward is with Chair White's leadership, for the Commission to look about the possibility of a balanced fiduciary standard across all products, and that I regret the possibility of having different standards with regard to the Labor Department proposal and what exists in the securities market. I absolutely agree with you. The present regulatory structure is strong. We bring, as was noted, over 1,000 enforcement cases each year. The rules with respect to suitability and supervision that exist in the securities markets for broker-dealers, combined with regular examinations and oversight with regard to Finra and the SEC, are things that investors should feel very good about and results in strong protection.
Let me ask you a couple of questions about the cards proposal, just real quick. Relating to a study that was mentioned in the Wall Street Journal piece this morning, something that's been referred to in the past relating to the MIT study, that you can take. You don't need personally identifiable information if you have date, location, and four transactions. What is your opinion of that study, and how does that affect you all's thinking on the proposal?
Well, as we said in the written statement, we absolutely are committed to take no steps where we believe that there are, with respect to creating a new centralized database where there is significant risk with respect to reengineering. One of the values of the comment process was it brought things to our attention and raised issues. We've stepped back very much to evaluate those things. And as I indicated in the statement, we don't plan to move forward with cards
until those concerns are addressed.
Until
what does that mean? What can you share with us in terms of what that means when you say our concerns are addressed? Because I think that we'd like to have some idea of what the timeline is and how you get to that place. What are the things that you all that you are looking for in terms of addressing those concerns specifically?
Well, let me be first absolutely clear. I think the first step in that is that the goal around cards, how it's delivered, is to create a more effective early warning system so that we can identify serious frauds, serious sales practice matters that we can step in and react more quickly to before investors are hurt. We don't believe that account-level information is necessary for that, as we've reflected on it. So we are stepping back, having a number of conversations.
What are the security concerns? Because there are two issues. It seems to me there are costs and the need for it, the cost-benefit issue, but also the security issue is significant. And how important is that?
The security issue is absolutely critical. That's why I say anything we look towards doing from this standpoint will be done without account information. And we're looking at the alternative information that we already have in place, what information may come someday with respect to the consolidated audit trail, and evaluating those as alternatives as well.
Thank you, Mr. Ketchum. I yield back my time.
Gentleman yields back. Gentleman from California is recognized.
First, I want to pick up on the comments of the gentleman from Virginia and these Department of Labor standards. We have kind of a choice. We can provide the maximum protection to investors and in that way eliminate investment choices. You can only invest in plain vanilla. Or we can say you get a little less protection and you get a little more freedom and you can invest. We now have a system in which we provide, some would say more protection, some would say less options to my IRA than to my widowed mother's life savings. Is there any reason why middle-class people controlling their brokerage accounts should have different protection standards depending upon whether those accounts are IRAs? And if so, why would you provide, why are we developing a system to provide more of a straitjacket for me and less protection for my mother?
Well, first, I think it's a very fair question. I want to underline at the beginning, I am passionate from the standpoint of protecting investors, and I also agree with you that our system works because investors have a range of choice with respect to products built around a lot of requirements to ensure that what's provided to them is suitable. I do agree with, I think, your central premise. I think any of us, when we go about investing, don't think about investing with respect to tax advantage accounts differently than we think with respect to our other investments. And I think that a proper environment that properly protects investors, builds the right level of disclosure, requires the right focus on, with respect to the industry in managing their conflicts and ensuring those conflicts don't result in recommendations that harm investors, should look across products. And that's why I have tried to say that I believe the right direction forward here, with great confidence in Chair White, is for the SEC to look and reach its determinations as Dodd-Frank provided the capability across all products.
I would hope that the agency that could provide the same level of logical protection and or options to both the IRA account and the widow's savings would step forward. We've had some frauds. Often these frauds are perpetrated by well-mannered, well-dressed gentlemen. And then we have rules that seem to work only if someone behaves as a, quote, gentleman in the standards of England a couple hundred years ago. For example, it's important that the broker-dealers be audited. Do you make sure when you get the audit report that it was actually signed by the auditor by contacting the auditor? Or do you just need a good inkjet printer to forge the stationery? And then second, do you make sure that the auditor is large enough to handle that size client? If that had been done, of course, Madoff never would have gotten away with it. Do you take those two very elementary steps? It would be unnecessary if everybody behaved like a gentleman or a lady.
Well, audits are important. I think the exams we produce
do you do those two steps?
We do check with respect to the auditor. The PCAOB does have requirements as to what required levels of audits are and register auditors at this point. We don't have any rules that restrict size of auditors with respect to.
Well, the accounting profession has a rule. It says you got to be independent.
Right.
You got to be big enough to do the job. You got to be big enough to do the job without that job constituting 50 or 80 or 100% of your fees that you can generate in a year. So one person CPA firm can't do it. So you make sure that the auditor signed the report. You don't just look at the piece of paper and think that's good enough.
No, we don't go back to each auditor.
You don't bother because you trust everybody.
If I can clarify, the PCAOB has a regular oversight coming out of Dodd-Frank with respect to all auditors.
Yes, but they don't make sure that the report was actually signed by the auditor. Just all you need to do is steal a piece of stationery. Well, it shouldn't be that tough if your name is Madoff. But let me also ask you, you've got this broker check system.
Yes.
You got a lot of people. You're asking them about their bankruptcy, possible bankruptcies, criminal convictions, et cetera. When I've got a tenant, I can spend $50 and use a commercial service to make sure that the person reporting to me is telling me about bankruptcies, unlawful detainers, criminal. Do you use that, or is it just, or do you just count on the broker to tell you about these matters?
No, we do both. The Commission has now approved a rule that requires additional broker checks by the broker at the time that an employee comes in. And we do exactly those reviews and have just completed reviews of that across the entire broker check database.
And do you have an integrated system, since many of the people who are with broker-dealers are also involved in other investments like real estate, insurance, et cetera? Do you have a centralized system of all those who have been disciplined by the various state regulatory bodies that deal with real estate agents, insurance agents, et cetera.
Those disciplinary reports are required to be reported as part of the U4. We'd love to have a unified system, but we don't have the jurisdiction to do that.
Do you contact each state and get the data?
The firms are required and the brokers are required to put it in. We would love to have, and we have proposed, the states have been unwilling to have a uniform system.
The gentleman's time has greatly expired. The other gentleman from California.
Thank you, Mr. Chairman. I'd just like to follow up on Mr. Hurt's comments and some of your thoughts again on this risk-based surveillance, on how your early warning system would work. And I take it from your comments. And by the way, I share his concern about the way the card program was going. From your comments, it seems you still feel there's a way to collect data in the aggregate that's going to allow you to go forward without putting individual account level data at risk. Could you explain a little bit more about the timing, how long this is going to take, and what you have in mind there?
Well, first and foremost, it will take whatever time it requires, and part of that will be a decision as to whether we build a new system or not. One of the things we are doing, Congressman, is looking closely at the other information we have, the information we pull down from firms before exams, and the information that is available from our financial reports, and reach a decision. But if we do move forward with any proposal, it will go back to our board. It will be put out as a new notice to the industry and to other segments, investors and the like, and all of that will be done with a public comment period before we make a decision, before the board makes a decision as to whether to file the rule of the SEC.
Thank you, Mr.
So
Ketchum.
I would say it would take a considerable amount of time.
And then the short question I was going to ask you here about this United Kingdom rule that was implemented there last year to ban commission payments from mutual funds to brokers. And some of the statistics on that, about 310,000 clients stopped being served by their brokers because their wealth was too small for the broker to advise profitably, and then you had another 60,000 investors who were not accepted as new clients since then for that same reason. And I was going to ask you, are these statistics concerning, and do you believe that the Labor Department's fiduciary duty proposed rule could lead to some similar impacts here?
Well, I think the statistics are certainly concerning and should be part of the review of the Labor Department's rule. We're still in the process of reviewing the rule. I think the Labor Department made significant strides in creating a more balanced rule, but there are parts of the release and the description of broker-dealer business that we don't think is accurate. So I completely agree with your premise that moving to an environment where fee-only advisory accounts are the only effective way to operate in the United States is a very bad step, and that with respect to middle-class investors, the availability of both the choice between fee-only and commissions is important, and any steps that are taken should look carefully in ensuring that that type of environment remains in the United States.
And I'd also ask you how you respond to criticism that SROs are becoming a fifth branch of government, and Finra is starting to look a lot like a deputy SEC, as somebody said.
Well, I don't think we are anything like a deputy SEC. I do accept that Finra has a unique position that is different than other self-regulatory organizations, and with the merger with New York Stock Exchange regulation and our responsibilities, that does deserve very careful oversight. Finra is way different than a government agency. It has industry members on the board. It has the ability for informal access through committees and otherwise with regard to industry members. Those persons get the opportunity to look at it on an informal basis any rule that we propose or are considering proposing. We respond to those comments, and we also pass those comments on to our board. So I think what Finra is a independent organization that is informed in a very effective way from the standpoint of industry concerns.
Let me ask you one last question. It appears that we're moving towards expansive quasi or direct government regulation in retail securities markets, and I was going to ask if you think similar regulation is needed for private trading platforms known as dark pools, or is there a difference in your view between regulation of retail markets
and areas where sophisticated institutional investors are the market participants?
Well, it's an excellent question. I do believe there's need for greater transparency with respect to dark pools that are an integral part of the U.S. equity markets, and we, in fact, have had that occur from the standpoint of reporting requirements we built in. I believe there's a necessity for effective and aggressive oversight, and we try to provide that. I do think dark pools have a role in the complicated and sophisticated marketplace that we have, and we should ensure that that role continues to allow to occur, and it provides competitive balance and choice that is valuable. But to your point, I think it's a good time, and glad that the SEC has indicated their intention to step back overall and look at the equity market structure.
Thank you, Mr. Ketchum. Thank you, Mr. Chairman.
The gentleman yields back. Gentleman, Massachusetts is recognized.
Thank you, Mr. Chairman. Thank you, Mr. Ketchum, for your willingness to testify and help the committee with its work. I realize there's some friction here that is underlying some of the questions here, and that is, I think, because some people see you as an SRO and as an organization that is meant to serve your broker members, your members, and then some of us think that your overriding mission is really to protect the investor. So let me posit something. Suppose you have brokers out there that are doing high-frequency trading, and they're chasing rebates and fees instead of pursuing best execution on behalf of the investors. Okay, so your members are chasing fees and rebates, and the investor is being disserved by that practice. Where is FINRA's loyalty? Are you protecting your members, or are you protecting the investing public? That's the question.
Our statutory responsibilities and our passion is investor protection and market integrity. That also always comes first. High-frequency trading is not one thing. Much of it is proprietary and doesn't involve customer accounts, but you're right, some of them do. Many are sophisticated, but the concerns around high-frequency trading is a huge focus of our surveillance program. And while much high-frequency trading is effectively market-making in the environment that exists, there's
I don't
a
have a
lot
lot
to
of
focus
time.
on.
Let me just ask you that, though. You've raised a good point. In your current toolbox, are you able to properly surveil the conduct of high-frequency traders to make sure that in the course of executing those trades that the investor is getting the best execution?
Where that manipulative activity would be occurring in either the equity market, fixed income market, or options market, yes, we do. And we have had for years surveillance is particularly looking at things like spoofing, layering, marking the close, and wash sales, and brought numerous cases. You raised in your opening statement, Congressman, a valid concern with respect to the fact that we do not have a common jurisdictional program and a common program with regard to interest rate swaps and with regard to futures. I would note, for one thing, it would be great if futures activity was included in the SEC's proposed consolidated audit.
Yeah, let me just jump in here. This is the SEC has stated that FINRA is unable to monitor the off-exchange market activity of non-member firms and detect potentially manipulative or other illegal behavior as efficiently or effectively as it can the FINRA members. You agree with that?
Yes, that really relates to a recent SEC.
Are you operating with a full set of data?
We would, where the consolidated audit trail goes, which includes customer information.
Well, that's not up yet, though, right?
No, the step that the SEC is proposing.
Might be that I don't want to burn all my time here. I'm just trying to get a sense of where you're at and where you might need help.
Yes, the SEC has a proposed rule that addresses that, and we support it.
Okay. And what's the timing on the consolidated audit trail? We've been doing this for several years, and we're still some distance away, I imagine.
Well, I am on the other side of an information barrier. The exchanges in FINRA have filed a plan. The next step is for the SEC to publish it, and that has not yet occurred.
Okay. In your recent brokerage inspections, FINRA found that some firms do not have active best execution committees. So I don't know if the firms themselves are actually paying as much attention to this as they should. Is there a way, now you say we have some tools, although we're not operating with full or complete data. Is there a way currently where we can find out whether brokers are chasing the rebate and fees, and that should show in a pattern, or whether the preponderance of the brokers are actually providing best execution?
One of the things we particularly look at is whether brokers can justify where they place most of their customer orders. As you know, they tend to route them often to a predominant market site, and that is absolutely a concern of ours. Most firms do, but where firms don't, we look at either changing behavior or enforcement actions.
Okay, thank you. My time has expired. I yield back. Thank you, Mr. Chairman.
Thank you. Mr. Holtgren is recognized for 5 minutes.
Thank you, Mr. Chairman. Thank you, Chairman Ketchum, for being here today as well. I'd like to focus my comments and questions on the SEC and the Department of Labor's effort to expand the definition of fiduciary, which further extends federal regulatory control into Americans' financial planning decisions. This move could restrict the number of investment products financial advisors could offer to their Main Street customers, making it harder for average Americans to invest. I've heard loud and clear from my constituents about the negative consequences of a fiduciary standard, including the tens of thousands of small investors throughout the district I represent, the 14th Congressional District of Illinois. They tell me that this change would not represent true consumer protection, but would instead make it harder for Americans to plan for their future, put money away for their children's education, and invest. While customers need enough information and options from their financial advisor to decide what products they need, I believe there is a danger that a fiduciary rule would strip their ability to get advice and help. This is why I co-sponsored the Retail Protection Investor Act, which delays the proposed rule until the Securities and Exchange Commission issues its own fiduciary rule, and also requires the SEC to study alternatives to a uniform fiduciary standard and the impact of such a standard on everyday investors. Fiduciary proponents argue that a higher standard is needed because the current broker-dealer supervision regime is insufficient. Mr. Ketchum, my questions are really to that. Given that FINRA plays a significant role in a broker-dealer supervision, can you describe the current regulatory and compliance regime with which FINRA-registered broker-dealers must comply?
Yes, Congressman. We have a rigorous examination program in which all members, depending on their size and complexity, are examined between once every year or 4 years. We regularly are oversighting from a surveillance standpoint to identify instances that suggest that there is a problem with respect to how they are operating. We bring over 1,000 enforcement cases a year. As was noted earlier, we provide referrals to the SEC with respect to regulatory concerns that are outside of our jurisdiction, and we bar over 400 persons each year who are operating inappropriately from the standpoint of their position as registered persons. We also have rules focusing on suitability and on supervision and on written supervisory procedures that provide a very strong environment for investor protection. Can't say that it can't be better, but I agree with you that the care has to be taken exactly as you described, and it certainly would be preferable from my standpoint for the SEC to be the expert agency moving these type of issues forward.
Let me dig a little deeper. What steps must broker-dealers take to ensure that their customers are not confused about broker-dealer services? Are broker-dealers required to disclose to the customers material information about potential conflicts of interest? Must they also refrain from engaging in certain transactions if potential conflicts are acute?
Yes. The broker-dealers have an obligation to know their customers, evaluate their recommendations, ensure they are suitable, and there are numerous obligations from the standpoint of disclosure with respect to third-party payments or other issues from the standpoint that where a conflict may exist. Absolutely.
Thank you. Even if investors are confused about the differences between broker-dealers and investment advisors, is the only solution to impose a fiduciary standard of care on broker-dealers? Would additional disclosure to investors better protect them? Are there other ways to improve disclosure without creating information overload or imposing unnecessary regulatory burdens?
Yes, I think there are a number of ways, and I think it is a challenge for all of us from a regulatory standpoint to look for ways to increase the understandability of disclosure, and I think those are important points. I would note that a large part of a best interest standard should fundamentally be ensuring that firms manage their conflicts and provide proper disclosure. It should always have the balance that you described from ensuring that it also doesn't impose unnecessary costs.
Yeah. Fiduciary advocates have argued that Finra has a conflict of interest in their supervision of broker-dealers, which makes your supervision lenient. Can you respond to that?
Yeah, it's just absolutely not true. We are funded. One of the upsides of Finra is that we are not funded by taxpayer dollars. We are funded by user fees with respect to the industry. But industry members that do a business with customers are required to be a member of an association, securities association. Today, while they have the ability to start a new one, today there is only one, and that's Finra.
Well, my time is almost up. I do appreciate your time here and bringing some clarity for me and for others, hopefully here as well. As I do talk to advisors, broker-dealers that I know in Illinois, they certainly don't feel underregulated, and sometimes they complain maybe that it's too much. But I think it is important, again, for that confidence to be there. So my time has expired, but thank you very much for being here, and thank you for your help on these questions. I yield back.
The gentleman yields back. Going down to the very first row, Mr. Poliquin is recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Ketchum, thank you very much. I appreciate your opportunity, or your willingness, rather, to be here today. Thank you. There are many of us on this committee, sir, and throughout Congress that are getting concerned about the expansion of regulators throughout our Federal Government. There are all kinds of examples of this, Mr. Ketchum, that are beyond the lines within which you operate. For example, the Internal Revenue Service intimidating taxpayers, law-abiding citizens, because they share different political views. The EPA is repeatedly overreaching, making it more difficult for some of our companies, our manufacturing businesses, to grow and hire more people. We had a fellow from the FDIC who was a regulator before our committee about a month ago. And it was disclosed that the examiners at the FDIC are putting pressure on community banks to stop lending money to lawful businesses they deem undesirable, like firearms dealers or folks that sell tobacco. And now we have the FSOC group that seems to be wanting to put more and more taxpayers at risk in the event that a significant financial institution goes under. So this is a real concern of mine, and I come from the general industry that you're involved in now, sir. And would you agree with me that when you increase regulations like this, you drive up fees, you drive up complexity, and those folks that are trying to save for their retirement and invest for their kids' college savings, that this could be an impediment to the choices they have with respect to the investment vehicles they want to have and the rates of return that they need to save for their kids' education and also plan for their retirement? Can we agree on that, sir?
Well, I can certainly agree on the goal. I can't speak to a variety of other regulatory agencies, but I can tell you that that is very much the goal from FINRA's standpoint. We don't want to take any regulatory action where the burden exceeds the cost, and that has to be a serious concern.
Good. And I also have a concern, Mr. Ketchum, that it looks like now the Department of Labor and the SEC are sort of competing over who in the heck is going to regulate the investment manager community and the mutual fund industry. Why in the world would the Department of Labor want to get involved in that space where they have no experience regulating the investment business? And to that end, if I may, now we have this discussion about imposing fiduciary standards on brokers. Same fiduciary standards that maybe a pension fund manager who's running $50 billion. We had a fellow here from Rockland, Maine, just over the border. I represent Western Central Down East.
Rockland, Maine is a beautiful
place. Thank you, sir. I appreciate it. Well, if you haven't been there recently, you ought to go back, and I appreciate that very much. But this gentleman came in. He's a broker in a small shop, and he has about 200 customers. And his customers, you know, they maybe move some snow in the wintertime. They do a little lobstering. They do a little bit of logging. And they're saving the best they can for their retirement. And this fella is very concerned because if these regulations get too burdensome on him, he's going to stop meeting with this couple that he's helping them plan for their retirement. And all of a sudden that advice leaves. This couple and his clients may become more subject to scams. that would hurt their nest egg going down the road and put this couple more at risk to become more dependent on the government. So don't you agree that it probably makes sense to have the folks at your organization who has the experience of regulating brokers? I think you regulate 640,000 brokers across this country. Don't you have the tools to continue to do this? Why do we need to have other folks like the DOL involved in doing something like this?
Congressman, as I've indicated, I believe that this would be better if the SEC led and Finra worked with them to have a review across all products. And I think your concerns are very real and appropriate to be focused on. Of course, it is also important to look where we can improve disclosures,
sure,
and where we can improve handling of conflicts. But I agree that there has to be a careful focus, and I believe the SEC is the right agency.
Am I listening to you then, Mr. Ketchum, today you commit to me and to this committee that you'll speak up loud and clear when it comes to other folks that want to go beyond their lines, such that the right people are making sure they regulate the right participants in this industry?
While I believe there should be a best interest standard, I do believe the SEC should lead it, and everything I've said today I have said earlier and will continue to say.
And do you believe that the 640,000 brokers that you folks regulate are fairly regulated?
Yes, sir, I do.
Okay, you don't think they need any additional fiduciary standards imposed upon them. Is that correct, sir?
There are always opportunities to improve the regulatory structure.
Have you looked at the proposed have you looked at the proposed rules that are coming out of the DOL? Do you agree with them?
We're still reviewing them.
And when will you make that decision?
Would be for the SEC.
And when will you make that decision?
We certainly are considering the possibility of providing a comment letter to the Labor Department.
Okay. And I'm also assuming that every time you consider a new rule imposed on any market participants that are trying to help our families save for their retirement, that you look at what the cost will be in imposing that new rule. Is that correct?
Yes, sir, as well as the alternatives that may be less costly.
Great. Thank you very much for being here. Appreciate it.
Thank you.
I yield back my time.
Thank you for your questioning and your advertisement for Maine. Mr. Hill is now recognized for 5 minutes.
Thank you, Mr. Chairman. And Mr. Ketchum, it's nice to see you before the committee, and I've certainly enjoyed my over 2 decades of friendship with you. I want to associate myself with Mr. Poliquin's line of questioning. I thought it was excellent, because do you think that DOL has stepped outside their box, outside their balls landed outside the fairway in terms of the scope of what they're trying to do? In other words, they've got the right to oversee a group retirement plan. No one argues with that, and they can set those standards. But what about the relationship between that individual investor and deciding to roll that into an IRA, or what the composition of it is, or whether it's a fiduciary standard or not?
Well, my understanding is they do have the jurisdictional ability to take that step. As I indicated earlier, I believe that while the investor protection issues around the decision to roll into an IRA are meaningful, things that we've addressed, as you know, with respect to investor alerts and with respect to our exam and enforcement program, they are part of a wide range of issues for investors, and I think that there would be great value in looking at these issues from the standpoint of the SEC as the expert agency.
Would you commit to write a letter to the committee that outlines all the existing rules and regulations that govern investor protection in the retirement arena now, that brokers and financial advisors are already living by, that protect investors? Because I think it's extensive. I think your work there has been exceptional. Finra was the first organization to lead a senior sweep effort of the financial industry. That's been over a decade ago, and you've been focused on educating brokers and broker-dealers and managers on this issue for years, and I think it's demonstrated results. I think the committee needs to know that this is already being done, and that the DOL's effort is a redundant, unnecessary exercise.
Well, Congressman, first, thanks for those words, and yes, we would certainly provide a description of all of our programs. We'd be glad to.
Thank you. I want to talk a little bit about also, small firms, of which you have many among your 4,000, have absorbed the Y2K hysteria process from Finra, trace reporting, OATS and RTRS reporting, mutual fund pre-sale planning, VA pre-sale planning, written whole documentation, which is the latest of the continuing hits from Finra. How do you balance, even despite your Small Firms Advisory Committee, how do you balance this issue that we're losing small firms like we are losing small banks? I think 3 or 4% of the firms exit membership every year. How sensitive is the agency to that, and how sensitive is the SEC to that?
Well, I can't speak for the SEC. It is certainly a focus from the standpoint of FINRA. We care very much about the burden of our rules. In fact, one of the areas where we're taking initiatives now is a retrospective rule review. We've just done it and taken an initial proposal with respect to a variety of amendments to our advertising rules in response to that. I think we always have to keep analyzing the rules that are already in the books and determine whether they're imposing burdens across the board, particularly to small firms that could be less. We're going to do that with respect to our membership and change of business rules that you're very familiar with, I know, from your days in the industry. Again, looking for ways to maintain the investor protection benefits that come from those rules, but to reduce burdens.
I was pleased to hear you talk about the difference between the agency business and the fiduciary business. And one of my concerns across the regulatory system has been that we ignore the customer here. Washington consistently ignores the customer. For 70 years, we've had a disclosure-based, caveat emptor, suitability, management-focused securities regulatory system, where the individual investors do have to take some responsibility for their own investments, wealthy or not wealthy. And some people want an agency-broker relationship, not a fee fiduciary a relationship. They don't want it. They don't demand it. And yet I feel like we're compelling and pushing the industry as if that's going to be a savior for something that I'm not even sure what we're being saved from. Would you elaborate just for a minute on this issue between agency business and fee or fiduciary-oriented business?
Well, certainly there are a variety of characterizations of fiduciary.
We want both, don't we, for our customers across the country, whether they're rich or poor or middle income?
I certainly think it is important for customers to have choice, and I think it is important that no steps are taken that reduce the ability for customers, particularly who are relatively inactive, to have access to commission-based accounts. I do believe there are ways to improve the disclosure and management of conflicts today, but yes, it is very important to make sure that that's balanced in a way that continue to allow customers to have choice.
I really think that, I think that it looks convenient to have a fee-based product for people, and that somehow commissions have this bad reputation, and yet in many cases I think if you were to analyze your account, the people on commission pay far less in managing their money on an annual basis potentially than someone who's on particularly a small account, say under $500,000 would pay if they were in a fee account.
I think that is a very real concern, and I think that for many customers, commission-based is, given the fact that they're maybe making a couple of transactions or investing in one mutual fund in a particular year, commission-based is absolutely critical to have.
One final quick question. ETFs. When I was in the business, there were only maybe 100 funds and $100 billion. Now there's 1,600 funds and $1.6 trillion or so in exchange-traded funds. Do you think it would be useful to have greater research, more access to research on exchange-traded funds for retail investors?
I know there's legislation that's put up there, and that has been a point made by a number of industry representatives. I do believe properly designed an environment that encourages more research, addresses some of the Section 5 offering issues with regard to ETFs, where the research is not designed to push the ETF, but to provide sector-based information that allows investors to make better and more knowledgeable choices. That's certainly an area we'd be very glad to talk with your office about and look for solutions.
Thank you, sir. I yield back.
Gentleman yields back.
Indulgence on that.
Sure. Mr. Messer, you're now recognized for 5 minutes.
Thank you, Mr. Chairman. Thank you, Chairman Ketchum. Appreciate your testimony. Appreciate your stamina as well. I want to take a moment or two and talk a little bit about the importance of arbitration and ask for your comments. And as you know, arbitration of broker-dealer disputes has long been used as an alternative to the courts because it's a prompt and inexpensive means of resolving often complicated issues. Broker-dealers advocate strongly for FINRA to continue its role as the primary forum for the resolution of consumer disputes and arbitration. Some have claimed, as I know you're well aware, that mandatory securities arbitration is unfair and prevents retail investors from exercising their rights to a jury trial to resolve disputes. But the broker-dealers that I hear from back in Indiana believe that FINRA's direct market knowledge and your real-world experience make you the best suited to continue the role as the primary forum for the resolution of consumer disputes and arbitration. If the SEC, this is the question I want to get to, if the SEC exercises its authority in Section 921A of Dodd-Frank and either restricts or eliminates arbitration agreements, do investors win or do lawyers win?
Well, Congressman, I am very proud of our arbitration and dispute resolution system. I think it has sought to continue to improve, to continue to provide the right balance with respect to public arbitrators, and I think that any system that did not ensure that investors had access to that arbitration system would be a very bad impact on particularly middle-class investors.
Yeah. Do you have any reason to believe that securities arbitration contributed to the financial crisis?
No, I don't believe securities arbitration contributed to the financial crisis at all. No system is perfect from the standpoint of its performance, but I think securities arbitration is in many, many ways very different from the rules around it from consumer arbitration otherwise, and I think it provides an independent, balanced, and fair resolution of concerns in a quicker and lower cost environment for investors.
Yeah. And could you comment on any specific improvements that you've tried to make at FINRA to deal with the consumer experience in arbitrations?
I would be glad to. We've taken steps to improve and to address concerns with respect to the motion to dismiss and discovery process. We've provided the capability for either side to demand an all-public panel that does not include anybody with respect to industry background. We have also changed the definition of public arbitrator to ensure the absolute independence of those persons. I believe that the steps taken and the input from both the industry and plaintiffs' lawyers have been enormously valuable, and the steps taken have been true positive steps for investors.
Well, I appreciate that. Just in my final minute or two here, some earlier testimony talked about the Equity Market Structure Advisory Committee. SEC Chairwoman Mary Jo White has talked about trying to make that comprehensive and data-driven. I believe that you're a member, will be a member, participating member of that Structural Advisory Committee. Is that correct?
That is correct.
It starts on May 13th. And earlier, I think you already testified that you're looking forward to that and believe it should be a holistic review of market structure?
I'm very much looking forward to it. I think the regulatory steps the SEC has taken over the last 15 years on the whole have provided real benefit for investors. But the markets have evolved in ways that raise real concerns. I was on an earlier advisory committee of the SEC and CFTC when we made a number of suggestions to review, including on things like maker-taker fees, often referred to as rebates. And I think this is a great time to step back and look at those issues as well as look at the impact of SEC rules in the new market environment. Yeah. So, yes, I'm very much looking forward to it.
And in the limited time I have, I just, in that spirit of some of the suggestions you made there, would ask you about regulation NMS, which, of course, many believe may be an underlying factor behind increased market fragmentation, the proliferation of trading venues, fee models, complex order types, and advanced trading strategies, including high-frequency trading. Could you comment at all as to your belief in the impact of regulation NMS?
Well, regulation NMS had many positive impacts from ensuring best execution and encouraging competition, but it certainly has resulted in more fragmented markets, and it doesn't distinguish between marketplaces that are very, very small and other markets. So I think this is a good time to step back and look at Reg NMS, and I congratulate Chair White in including that as a key early focus of the committee.
Thank you. Yield back.
Thanks. The gentleman yields back. Looks like all the members have asked questions. We obviously had a shorter number of members here, I think, due to the votes. So without objection, if I've asked a couple of other members have any additional questions? No? 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 I do. Just a couple. And it sort of throws off of Mr. Lynch's reference to the approach to SROs in general, where, I don't know, put words in his mouth, that he was saying something to the effect of how some people want SROs to be regulated, be controlled by the industry, and other people want it to be more of not SROs at all, just a regulator doing things. And I think the answer is obviously somewhere in the middle. So two things. One, back in the end of last year, October or something like that, the New York Exchange took back some of their, not their authority, took back some of the responsibilities that had been with Finra since 2010, I guess it was, right? And they are now setting up their own, surveillance system, I guess you'd call it, and the rest. So they're going to be doing it all in-house, if that's right.
No, they're not going to be doing it all. They haven't begun anything. They took back, on a going-forward basis, looking at their floor-related New York Stock Exchange only rules. We continue to do the cross-market surveillance for New York Stock Exchange and all the markets that allows us to look across markets to address and identify manipulative activity.
So exactly what are they taking back?
They're taking back rules with respect to how orders are handled and the small amount of trading that occurs in the floor, and some of the New York only rules that relate to how firms handle orders away from the floor.
So that's what they're doing now. So they're not.
They're not doing anything now. We continue to do all of it now. They're in the process of building the surveillance capability to do that with respect to their own rules. Cross-market rules we will retain, and we're very grateful to New York that they've allowed us to do that.
Okay, and so they have no, because I'm just going by press reports. So the press reports, it seemed to be more that they were going forward with more of a full surveillance system eventually that they would be setting up.
The press reports overstated it. They will have a surveillance system for their own rules. It's not likely that that will occur to the end of this year.
Okay. The earlier gentleman referred to over the Mercatus Center made references, and I'd have to look back where it was, to proposals to make SROs more shaped by, reflective of the industry, if you will. My words, not theirs. And he has had a number of proposals in that respect, and I didn't go through all of his proposals. Are you familiar with that at all that I'm referring to? Before I go into it,
I read Ms. Pierce's study some time ago, so I'm not sure I'm positive with respect to each one of them.
Okay, I'm not going to go there at all. But part of it is the broad 30,000-foot level, I guess, I'll throw that out, is to allow for, and it sort of follows off my NYSE statement, to allow for additional third-party entities to be able to compete, if you will, with Finra, to allow for, if we go down the road to additional standards as far as the industry is concerned, to allow for independent entities to be able to perform the examinations as opposed to Finra. These are not new ideas. Can you just respond to those ideas?
Well, from the standpoint of market surveillance, obviously much of the responsibility.
Oh, not on the surveillance.
Oh, but on examinations.
Examinations, yeah, right.
I think one person with respect to the lack of resources, the SEC and the investment advisor side, Commissioner Gallagher has made, I think, very thoughtful suggestions about the part, and Chair White has indicated her interest and support about the possibility of third-party exams for investment advisors to deal with the fact that the SEC doesn't have the resources. The statute itself allows any group of firms to set up a separate National Securities Association if they wish to have an alternative to FINRA.
Okay, so that'd be for investment advisors. That's what they're talking about. Is that
at least the proposals I know about are for investment.
Is that a possibility? If they can flesh that out, is that a possibility then to expand that over to broker-dealers as well? And so you have a competing network, but both regulated as well in the broker-dealer realm?
I would view a possibility of for-profit third-party examiners that are paid by the firm to do the exam as a least good
Well, that's the same. That would be
better
the
than, it's better than
same
nothing.
situation you would have with if Chair White goes ahead with in the.
If there aren't enough resources, which certainly exists with respect to investment advisors, it's certainly better than nothing. I think having firms who are paid directly by the the entity to do exams is speaking of conflict of interest, is a larger conflict that I wouldn't choose.
Right.
I think it's much better for firms, if they're not happy with FINRA, to create their own National Securities Association,
Okay.
which they have the right under the statute to do.
With that, I will yield to Mr. Hill.
New members of Congress get so little time to ask questions. I can't resist.
I yield the gentleman 30 minutes.
Plus, it's Friday. The staff has nowhere to go.
We can
You
do
have
lunch
nowhere to
if you
go.
want. I mean,
Yeah. Just to follow up on Mr. Messer's point about arbitration, in your aging of arbitration cases from start to finish, have you seen the length of time to come to a conclusion and issue a decision lengthen out? Could you supply me I use the word aging analysis in a business sense, because I have heard from constituents about 1 year and then 2 years, we don't have a decision, and the concept of speedy trial, even for an advisor that's got a serious matter, is of concern to me. Could you respond to that and provide some data on that?
We would be glad to provide data. I think there was a challenge a few years after the credit crisis, I believe, because there have been good things about up markets are there are less arbitrations. I don't think we have an aging problem now, but I can't speak confidently on that. We'd be glad to provide you information.
And then just one other thing on my favorite subject, cards, and you know my personal views on the cards proposal in detail. I won't burden the world with them here. But could you, it's my premise that FINRA can achieve the cards level intel with your existing authorities and your existing powers, and so through sweeps and through access of clearing firm data, you can certainly satisfy your curiosity about looking for patterns and potential fraudulent activity with that data stream you have now. Isn't that accurate at a big picture level, maybe not at the exact design level? And I'm asking you as the CEO, not the IT director. So, even if your enforcement or IT people say it can be done, I mean, people tell me that in my company all the time, but as Chief Executive Officer, I didn't go along with them, So I'm curious that, can't you achieve your public policy objective in a different way if you didn't have cards?
We can certainly achieve a lot. We can achieve a lot by using the data we have and the data that may become available over time more effectively. You're absolutely right there. I would love to have more capability for an early warning capability to jump in on serious frauds and sales practice pieces. But as I said in the written testimony, we're going to step back and look at all of that because they're fair questions, and we should complete that analysis before making any decision.
Thank you, sir. Thank you, Mr. Chairman.
Sure, thanks. So that concludes today's hearing. As always, for those members who were here or those members who are not here, we grant an additional 5 days to submit extraneous material to the record for inclusion in the record. And also, as we always ask the witness on notice, that for those members who are here or are not here, they may have additional questions that they will submit to you in writing for the next 5 legislative days, and we would ask that you to respond to those questions in a timely manner to the committee.
And I'd be pleased to do that. Thank you, Mr. Chairman.
Thank you very much. With that, the panel is excused, and the panel and Mr. Ketchum is thank you, and this committee is adjourned.